Hello everyone, welcome to Accounting 312. Today we continue with the chapter 3 talking about CVP analysis. So in this video we will finish the case 5 and the case 6. Case 5 talking about the bundle products. We said there are basically two types. One is talking about the ratio, the other is about the percentage. So for the first one, it said selling price is 12 and 5, then your contribution margin is 7, for Q is 15 and 10, so for contribution margin is 5. Then we get our contribution margin for this bundle, we said is 3M, and then 2Q, right? 2Q, and each one is 7 and 5. So you get your contribution margin for that bundle is $31. So our break-even point in bundle has to be fixed cost divided by our contribution margin per bundle. So that gives you 62,000 divided by your bundle contribution margin. So you have to sell 2,000 bundles. And then for product M, it has to be 2,000, and then each bundle you have 3 amps, right? You have 3 amps. So 6,000 of the M will be the break-even point. Okay, so next one is the percentage. We said in the class we talk about, we just use the percentage, but I did some work, I think using the ratio also works. So for this one, your contribution margin is 50, is 300, and then we said based on our class discussion is 60% from Y and 40% from Z. So if you take 60%, if you take 40%, that gives you 30, that gives you 120. So your bundle is $150, right? Your bundle is $150. So this is kind of like a weighted average. This is weighted average, let's say. And then your break-even point then will be your fixed cost 300,000 divided by your weighted average 1 unit of the product, which is 150. So that gives you 2,000 units, weighted average unit, which has 60% of Y and then 40% of Z. How about we said we just use a ratio, right? Two ways, 60% and then 40%. So we can just do 6 to 4, right? And then we have product Y and product Z. So we get our contribution margin for our bundle will be 50 times 6 plus this 300 times 4. We get 300 plus 1,200, 1,500, right? 1,500, and then our bundle will be fixed cost divided by contribution margin. So this is a contribution margin for that bundle. So we assume the bundle has 6Y and 4Z. But this one, we just assume is 1 unit, is 60% Y and 40% of Z. So our fixed cost divided by contribution margin, that gives you 300,000 divided by 1,500. So that should be give you, let me calculate quickly, 300,000, because, okay, 300,000 divided by 1,500. So that gives you 200 units. That gives you 200 of this bundle. That gives you 200 of a bundle. So that gives you 200 of this bundle. And then we said for each bundle, you have 6Y and you have 4Z, right? You have 6Y and 4Z. So for Y has to be 200 times 6 gives you 1,200. For Z is 200 times 4 gives you 800. So your units, total units has to be 2,000 in total. Similarly, if you say Y and Z, they are 6 to 4, but they are also 3 to 2, right? So if you do that, your contribution margin, I already have calculated now, is 3 to 2, and will be 400. And then your fixed cost divided by your contribution margin, you have to have, This one is 750. So you have to have 400 bundles. You have to 400 bundles, right? You have to have 400 bundles. Then each bundle, your Y is 3. So your Y will be 1,200. Your Z is 2. So your Z will be 800. So you still have a total is 2,000 units. Okay. So no matter what way, the answer is the same. For the percentage, we just take it kind of like weighted average. So once you get this one, then you just have 2,000 units of weighted average. 60% Y and 40% Z. But if you use a ratio, you get a bundle, like a 200 bundle, and each bundle has 6 Y and 4 Z, or 400 bundle, each one has 3 Y and 2 Z. Then you have to time the individual units to get a total unit. Okay, I hope you are not so confused. So I think just we are right. We just use the ratio. I would say use the ratio, and then don't forget to time that individual. If you do this percentage, then you don't need to time, because this is kind of already weighted average of your total units. Okay, the next one, similar, talking about your in dollars, right? And then we have already calculated. We already have calculated here, there, here, and there. We found out Y is 1,200 units, Z is 800. So Y is 1,200 units, and each one selling price is 20. Z is 800 units, and each one selling price is 500. So if you do the math, you should be able to get total break-even point in dollar amount is this much. Okay, next one, last one, talking about contribution margin and then gross margin. So we said many times, we have been talking about this in chapter 9. That is the reason I put chapter 9 ahead of chapter 3. I think once you have got absorption costing, variable costing, variable costing, this part should be straightforward to you. So we just do a multiple choice together using this formula here. It said if you, which one is wrong, right? If you increase fixed manufacturing cost, contribution margin will not be affected. Fixed manufacturing cost, contribution margin will not be affected. This is right. Because no matter whatever, as long as it's fixed, contribution margin will not be affected, right? If you decrease variable manufacturing, gross margin will not be affected. If you decrease variable manufacturing, gross margin will increase, right? This is wrong. If you increase variable manufacturing cost, contribution margin, if you increase variable manufacturing, contribution margin will decrease. This is right. If you decrease fixed manufacturing cost, if you decrease fixed manufacturing cost, general gross margin will increase. That's right. So only B is wrong. That is the reason. So this is how you will do this type of questions. It will tell you kind of what will increase, what will decrease. So you just need to know contribution margin is only affected by variable cost, no matter it's manufacturing or non-manufacturing, while gross margin is related with manufacturing, no matter it's variable or non-manu or fixed. So we do one more time. During the current year, you increased the variable sale. You need to know sales and the general administrative, the variable non-manufacturing, right? And keep your fixed expense the same. So you have a fixed non-manufacturing the same. You increase this. Okay, contribution margin, the gross margin will be lower. So you touch the variable non-manufacturing. You touch a variable non-manufacturing, contribution margin will be affected, but gross margin will not be affected. So this is not right. Contribution margin will be higher, but you increased your variable cost. So your contribution margin will be lower, right? Contribution margin and the gross margin will remain the same. This is right. Operating income will be the same under this and that. This one is right because you know the only difference of financial accounting or contribution margin is about the production. Is about the change of your ending inventory. I'll put it this way: change of your ending inventory, about your production and the sales units. This one didn't say about that, and we have been talking about this. We said no matter you put variable cost here or you put variable non-manufacturing cost here, as long as the amount they are the same, then your final number will be the same. So they said inventory account booked under financial accounting. So this is under absorption costing will be lower. No, we said it will be higher, right? Absorption costing, financial accounting, they are the same. We said only absorption costing can be used externally. So your inventory is always higher because it has the allocated fixed manufacturing cost. Or I feel I'm in chapter 9 again. So this one is choice is C. Next one, under contribution margin, under contribution, this is kind of variable costing, we call it CP analysis. Contribution margin will be your contribution margin, okay? So your fixed, it has nothing to do with your fixed, right? It has nothing to do with your fixed. If your variable increase, then contribution margin will decrease, right? So if your variable increase, your contribution margin will decrease. Yeah, so this is D. We have one more question talking about here, to get a net income of this. So we want to know, now it told you tax rate specifically, so you need to know this net income, that means your operating income is 15,000 divided by 75%, right? 1 minus your tax rate. So that gives you 20,000. And then how many units you need to sell? So we said fixed cost plus operating income divided by contribution margin. Fixed cost 25,000 plus 20,000 divided by your contribution margin. So contribution margin percentage is 60%. Selling price is $20. So our contribution margin is $12. So this is one more tricky there, right? So if you do that, you should be able to get the answer C. Okay, so this is how you get contribution margin. Contribution margin percentage, variable cost percentage. So those things you really have to know the relationship. So I think this is the last video talking about chapter 3. In the 3 videos, I kind of showed you step by step how I will solve the questions. If you have any question, just let me know. Email me, stop by my office, you know, or ask me before or after our class. Bye-bye.